Good afternoon, ladies and gentlemen. It is both an honor and a privilege to extend a very warm welcome to each one of you to the 61st webinar on recent judgment on reassessment proceedings under income tax and ASC 470 debt accounting basic and restructuring organized by CP Committee of the ICI. My name is C. Amit Agrawal, practicing in GST litigation and Rajasthan government subsidies, and I am delighted to be your moderator for this significant and knowledge enriching session today. To begin, I would like to offer my heartfelt welcome to the esteemed dignitaries who have joined us and whose presence elevate the stature of this event. First and foremost, I warmly welcome to our distinguished chairman of CP Committee, Sri Satish Kumar ji, Vice Chairman CP Committee, Sri Vishnu Kumar ji, our learned speakers for today, C. Amit Kothari ji and C.A. Shubham Kabra ji. Last but certainly not least, I wish to extend my sincere gratitude and a very warm welcome to all the participants who have joined us from across the country and beyond. As part of our ongoing commitment to professional development, these CP webinars are scheduled on Wednesdays and Friday. Kindly mark your calendars to join us regularly for this enriching experience. In just a few moments, we will commence the proceedings. But first, allow me to provide a brief overview of the CP Committee vital role in our community. In today's rapidly evolving global landscape, the responsibilities of the chartered accountants are expanding to embrace innovative challenges and opportunities. The future of our profession hinges on adaptability, continuous learning, and a forward-thinking approach. Recognizing this, the CP Committee is dedicated to fostering innovation by aligning our educational framework with the demands of modern business environments. Through targeted updates to the chartered accountancy curriculum, we ensure our members remain at the forefront of professional excellence. Moreover, the committee encourages ICI members to look beyond the traditional practice areas, exploring emerging domains in business and advisory services. To support this growth, the CP Committee offers comprehensive guidance via workshops, seminars, national conferences, and in-depth background material. We also nurture the next generation of leaders by empowering young professionals to take on roles as speakers and master of ceremonies in our programs, thereby building a robust talent pipeline for the institute. For this afternoon session, we have structured two insightful one-hour sessions, each covering important areas of professional significance. The first topic is recent judgment on reassessment proceedings under the income tax, followed by ASC 470 debt accounting basic and restructuring. Our distinguished speakers will illuminate these subjects with their unparalleled expertise, providing practical takeaways to enhance your professional toolkit. Moving to our first session, I am delighted to introduce C.A. Amit Kothari ji, a seasoned practicing chartered accountant and managing partner of his firm in Jodhpur since 1988. Renowned for his core expertise in direct taxation, C.A. Kothari ji has represented clients extensively before the income tax appellate tribunals in Jaipur and Jodhpur, as well as the Commission of Income Tax Appeals, successfully arguing over 1,000 cases. His proficiency extends to managing complex search and survey proceedings, complemented by his active involvement in seminars, conferences, and thought leadership through contributed papers. As the former editor of CTR, a contributor to leading professional journals, and a member of editorial advisory board of Tax World, C.A. Kothari ji continued to excel as a tax consultant, specializing in audits, appellate matters, and search operations. Please join me in welcoming C. Amit Kothari ji to share his insights on recent judgments. Over to you, sir.
Good afternoon, everybody. Thank you, Moderator Amit Agarwal, for introducing me so nicely. I am thankful to Satish Gupta, Chairman CP Committee in absentia, also C. Vishnu Kumar Agarwal, Vice Chairman CA Committee, CP Committee, Mr. Akshat and other technical CP Committee members who are present here, various participants from various parts of the country. It's really my privilege to share my views on certain recent judgments involving on Section 148 and reassessment proceedings. Friends, we all know that in the recent past, reassessment proceedings had undergone a lot of changes, and I just share, of course, it's my not the PPT, but the uh, PDF file I'm sharing with the various judgments which have tried to compile what all the recent judgments of 2025 I've tried to compile with, and on the important subject of reassessment proceedings. I was discussing that provisions of 148 had undergone 147 to 153 has undergone a lot of changes in the recent past. We've seen that earlier there was reasons to believe, and 147A, 147B was there prior to 1989. Then the concept of reopening was slightly widened and the words reason to believe were omitted. Still, the escapement of income was, the income escaping assessment was there. Then major changes were also brought into the statute by 2008 Act, again in 2009, then 2012, 2016, 2021, and 22, and even latest 2024, the amendments were brought in. The various judicial decisions that we see have been, there has been a lot of litigation on this aspect of reassessment, and various important judicial decisions have been rendered on this aspect. And most of the decisions, the principles laid down in those decisions still have been the landmark principles which have been laid down and are being still followed. I'm just reminded of a short story. One philosopher, he was summoned by the tax collector, who claimed that he had reason to believe that the philosopher was hiding his income from teaching. The philosopher calmly replied, "You may have reason to believe, but do you have belief with reason?" The collector was puzzled, and the philosopher continued, "If belief becomes first and reason later, it's taxation. If reason comes first and belief follows, it's justice." The difference between arbitrary reopening and lawful reassessment is exactly the same. Reason must precede belief. And that is how, even in the GK and drive shaft, the Honorable Supreme Court had tried to lay down the procedure, how the reassessment proceedings should be taken up, and what precautions, what safeguards should be kept into mind while reopening an assessment. It's a vested right of the SSC that assessments, completed assessments, are sought to be reopened. Then there should have been a very reasonable ground to believe that certain income has escaped assessment, which has resulted into the assessment to be reopened. The reassessment proceedings, if we look at the recent past, the controversy started with the COVID period, when the relaxation were being provided by the TOLA Act and various notification issued from time to time. We all know that due to COVID on in March 2020, the period for issue of various notices, the orders to be framed, the various appeals to be filed, those were all extended. And initially, the extension was being granted on 31st March 2020 by the President Ordinance, and the dates were extended to 30th June 2020. Then later on, these were extended to 31st March 2021, and TOLA Act came into place with effect, retrospective effect from 2020 by the TOLA Act of 29/9/2020. Then later on, further extensions were being made in 2021. The initially the dates were extended to 31st March, and later on 30th April, and ultimately to 30th June 2021. The time limit for issue of notice, the time limit for passing of various orders, time limit for filing of various appeals, etc., were all extended. The proceedings under reassessment for which were initiated after 31st March, between the period from 1st April 2021 to 30th June 2021, was the main controversy, because by that time the new Finance Act 2021 had also come into place. The old act, major substitutions of the various provisions of the old act were being made, and new provisions with regard to the time limit, with regard to the quantum of income escaping assessment, with regard to the approvals. Those were amended by Finance Act 2021 with effect from 1st April 2021. The department which had issued notices between these period from 1st April to 30th June, following the old law which prevailed up till 31st March, taking a shelter that because the TOLA had extended the limitation period to 30th June, the notices which had been issued under the old act would be valid and still they would be in due time. That led to the controversy, and the arguments by the SSC was that since the act has been replaced by a new act of 2021 and the old law has been substituted, the provisions of new law would prevail and the old act cannot be applied with. And the amendment which were brought in by the new act, following the procedure which has to be followed by under 148A, that were not being followed, and therefore the challenge was being made. And the various courts accepted the plea of the SSC that the notices which had been issued under the old law after 1st April 2021 were not in consonance with the provisions of the Act, and the notices issued after the said date or the assessments which were made after following the old provisions of law were held to be not valid. And this resulted into the case of Ashish Agarwal, where we all know that 9,000 cases pending before the various courts or before the Honorable Supreme Court were decided by a landmark decision in the case of Ashish Agarwal. Various important principles of law had been laid down in the case of Ashish Agarwal by the Honorable Supreme Court, and the interpretation of various provisions, the various new interpretation of the taxation law have been made by the Honorable Supreme Court while interpreting the provisions, and a balance has been sought to be drawn between the SSCs and the department so that the due taxes or the legitimate taxes which the department or the revenue deserves may also not be deprived of those taxes, and simultaneously the safeguards which are available to the SSC may also be maintained. It's a very detailed decisions, and I can honestly say that every time when you go through this judgment, you find that there are various new interpretations, various new provisions which have been held by the Honorable Supreme Court. And we must admit that the Honorable Supreme Court had put in a lot of efforts. Even the consuls who had argued the matters before the Honorable Supreme Court had put in a lot of labor while arguing these matters, and various new principles were being argued and were considered by the Honorable Supreme Court. The I'm just briefing what principles which has been laid down by the Honorable Supreme Court in this decision, and they have held that reassessment notices which were issued under 148. The validity of those notices issued after 31st March 2021 vis-a-vis applicability of 148A were held to be valid by the Honorable Supreme Court, though the various high courts have declined to accept that those notices were valid. The Honorable Supreme Court also considered the substituted provisions made by the Finance Act 2021, which says that no notice could be issued under 148 without following the procedure prescribed under 148A. This principle was also accepted by the Honorable Supreme Court that any notice which is being issued after 1st April 2021 that must follow the amended provisions of law, and the new provisions which were introduced by Finance Act 2021 has to be applied while initiating the reassessment proceedings. The guidelines which has been incorporated in the statute on the basis of the decision of Honorable Supreme Court in GK and drive shaft was also considered, and it was observed that the notice under section 148 cannot be issued unless the procedure under 148A has been followed, which requires that the information material which has been gathered by the SSC before issue of such notice, that should be given to the SSC. His objection should be invited on those material, and after passing a speaking order on the basis of reply and submissions received from the SEC, whether it is a fit case for initiating proceedings under Section 148, thereafter only, with a reason to order to be provided to the SEC, the notice under 148 can be issued. However, the Honorable Supreme Court also observed that if the view of the various high courts is accepted, then that would result into no reassessment proceedings. Though even under the new Finance Act 2021, which has been substituted by the Finance Act 21, the new provisions which have been introduced from 1/4/21, that way also reassessment proceedings could have been initiated. But if those notices issued earlier between 1st April to 30th June is being quashed, then that would result into no reassessment proceedings. And revenue cannot be held remediless, and the object and purpose of the reassessment proceedings would get frustrated. And they also accepted that that was a bona fide mistake on the part of the revenue, that they issued the notices under Section 148, applying the old provisions of the law, and they have not followed the new provisions which were introduced from 1st April 2021. The court thereafter tried to find out a solution to the entire issue. Holding those notices to be valid, they they stated that that notice should be presumed to be a notice issued under Section 148AB, giving an opportunity to the SSC to submit its response to the material which has been collected by the assessing officer while issuing the notice under Section 148. And therefore, they directed the revenue to provide the material and information within 30 days of the when the matter was decided in Ashish Agarwal on 2nd May 2022. They directed to provide such material with the notice to the SSC, and the earlier notice was deemed to be treated as a notice under 148AB, and the reply to be received from the SSC on the material collected within 2 weeks, and thereafter the proceedings should be taken further. The another important feature of 148A which required prior inquiry or prior approval from the specified authority before issuing the notice under Section 148A was also dispensed with as a one-time measure. And since the notice had already been issued prior to the decision of our Honorable Supreme Court, and the earlier notice was deemed to be a notice under 148B, it was stated by the Honorable Supreme Court that the inquiry which we dispensed with, that was a one-time concession given to the revenue. And the object of the Supreme Court was that the purpose of the SSC would be achieved when the opportunity is being given to the SSC and he has an opportunity to submit his objection to the material collected. And once those objections are being considered, a fair amount of justice will be given to the SSC while initiating the reassessment proceedings. But the fact of the matter remains is that in most of the cases where such notices were issued, the proceedings under Section 148 were initiated, and again a second round of litigation came up before the Honorable Court. The Honorable Court in Ashish Agarwal case, they have decided the main principle with regard to the applicability of TOLA with the period from 1/4/2021 to 30th June, but the period of limitation was left open, and it was to be decided on case-to-case basis on which the reassessment proceedings can be initiated, what will be the quantum of income, because on the basis of material only it can be judged what is the quantum of income which has escaped assessment, what is the relevant assessment year, and the approval, etc., which is required to be done. Therefore, the limitation under Section 148 was left open by the Honorable Supreme Court in the case of Ashish Agarwal. This has resulted into another set of litigation, and the another judgment of a very again an important decision of Honorable Supreme Court in Rajiv Bansal came with regard to interpreting the provisions of law and the earlier decision given in the case of Ashish Agarwal, and how the balance can be drawn between the TOLA Act, the old Income Tax Act, and the new Finance Act 2021, which has merged into the Income Tax Act. That is the beauty of this second decision of Rajiv Bansal, where a lot of interpretation with regard to the limitation has been with regard to the year where notices can be issued, the limitation which will apply to be seen, the authority, specified authority who will grant the approval had been all considered in this latest decision. But friends, again, various litigations on these aspects are still going on in various high courts. And as we all know that even the provisions of JAO and 151 and the approving authority, and even there are conflicting decisions even after these two important decisions which have come up. As I said, every time when we read these two decisions, we come up with a new interpretation, new provision of law, new direction in which an interpretation can be made. If we look at the decision of Rajiv Bansal, the important principles which have been held by the Honorable Supreme Court in this decision is the provisions of 149(1). They've held it is not prospective, but it's again in a very limited sense that they have also applied the provisions of Section 149 in a limited sense to bring into an harmony with the Tola Act and also to bring into harmony with the existing provisions of law. They have referred to the provisions of Tola Act, which provided for the time limit, which falls for completion between 20th March and 31st March 2021. And the TOLA provisions apply for those period which comes within this period, and the extension, relaxation of limitation had been provided to these periods. The Finance Act 2021, the earlier law provided for 4 years and 6 years. Then the amendment was made. The period of was kept lower down from 4 years to 3 years, and in certain cases to 10 years and 16 years. The extension was being made. Then the provisions with regard to 151, the new regime provided a time limit within which the prescribed authority has to grant sanction. And it was observed that the provisions of 151 of the new regime, this does not provide a time limit within which a specified authority has to grant the sanction, but it is linked with the time limits within the limits of the jurisdiction of the authority to grant the sanction. The important provisions were discussed because various challenge was being made with regard to the authority who had granted the sanction for issue of notice, whether it should be as per the old provisions, whether the joint commissioner within 4 years or the principal commissioner beyond 4 years can grant the approval, or under the amended law where the principal commissioner or the chief commissioner is authorized to grant the approval. Those provisions had also been considered. They have also held that the period from 1st April to 31st March 2021, that was on account of TOLA, that has remained stay. And further, the time when the Supreme Court had decided the matter in 2022, that period was to be excluded. And the further time which was being allowed to the SSC to file the reply, and 7 days time to where to work out the surviving time limit, that has to be considered with reference to the time available till 30th June. And they've also illustrated the limitation period, how it is to be computed. And in the very said judgment, they've computed how the extension period and the surviving period has to be computed. This interpretation has also come up before the various high courts and in various judicial decisions, which I will be also touching upon in my further deliberations. I'm just skipping few of the provisions which are not very important. Uh, the two issues which were uh, decided in the Rajiv Bansal case was whether TOLA and notification issued under it will also apply to reassessment issued after 1st April 2021, and whether the reassessment notices issued under 148 of the Act between July and September are valid. These were the important issues which were decided by the Honorable Supreme Court. They've examined, the Honorable Supreme Court, they have examined the interplay of TOLA and 149(1) of the new regime. And they've discussed that in context of the reassessment proceedings, the first provision of 149(1), which provides for the time limits for issuance of notice under 149, it can be from 1st April 2021, and if the time limit has already expired under the old regime. And for the assessment year 18-19, the 4 period under the old regime which expired on 2023, but under the new regime, the time limit is reduced to 3 years, which expired on 31st March 2022, then the limitation of 3 years would be applicable. And accordingly, if the monetary limits are higher than, if it is exceeding 50 lakhs, then beyond 3 years, it could be issued. Similarly, under the old regime, the time limit was 4 years with an extension up to 6 years and income exceeding 1 lakh. And this has been extended to 50 lakhs under the new regime. Then for 17-18 also they've considered that under the new regime, if the period expired of 3 years on 31st March 2021, then because of the TOLA, the revenue could issue notice up to 30th June 2021 because it is falling between the period of the TOLA period here. The consequences of these two decisions had been that the old regime notices were regarded as show cause notice under 148B, and the proceedings were held to be valid. This decision was made pan India application, and all notices issued between 1st April 2021 to 30th June 2021 under the old regime were held to be valid notices. For protecting the rights of the SSC, the notices were treated as show cause notice, and the time was allowed to the SSC to respond to these notices, and the objections were to be considered. The important aspect of Article 142 was also taken shelter of by the Honorable Supreme Court while deciding these cases, and in the larger public interest, they tried to declare the law of the reassessment proceedings. Though the proceedings were held to be not valid in accordance with the provisions of law, but to safeguard the interest of the revenue, they held that these provisions to be valid, and a mode of conducting further inquiry, further proceedings were being let down, and accordingly the assessments were required to be made to meet the end of justice. I just tried to compare the consequences of the validity of the notices which were issued between 1st April 2021 to 30th June 2021. I prepared one table. I will try to show it on the screen also. So for assessment year 13-14, the limit of 3 years, this expires on 31st March 2017, and then the income is below 50 lakhs, then the notice cannot be issued. Similarly is the position with assessment year 14-15. If the income is below 50 lakhs and it is the limit of 3 years if computed up to 31st March 2018, then the notice cannot be issued. But if the income is above 50 lakhs in 13-14 and 14-15, then the normal limitation would have expired on 31st March 2020, which is within the extended period by TOLA. And therefore, in these cases, the notices can be issued till 30th June 2021. 13-14 and 14-15, if the income is exceeding 50 lakhs, then the notices can be issued till 30th June 2021. But if it is below 50 lakhs, then the benefit of new limits by the Finance Act 2021 would be taken into consideration and the proceedings will not be initiated. For 15-16, the 3 years period that expires prior to the TOLA period and it expires on 30th March 2019, and therefore the proceedings for 2015-16 will not be valid. And even before the Honorable Supreme Court, the revenue had also accepted that for assessment of 15-16s, under both the limits, and whether it is below 50 lakhs or it is above 50 lakhs, that proceedings would not be cannot be initiated and it will become barred by limitation of time. For all other years, for 16-17, 17-18, 18-19, 19-20, and 2021, the even under the amended law of Finance Act 2021, the proceedings would be valid and the notices could be issued till 30th June 2021. Another set of litigation which came up before the Honorable Supreme Court was between the notices which were issued between 1st July 2021 and 30th March 2024. Because after the decision which was rendered by the Honorable Supreme Court in 22, thereafter the notices were issued and the proceedings under 148 were being initiated. Any notice issued after 1st June of 30th June 2021 after between 1st July or till 31st March 2024 for 13-14, that would be invalid because it would the limitation period will expire. Similarly, would be the position for 14-15. If any notice is issued after 30th June, then that will not be a valid notice. 15-16, it will not be a valid notice. If it is the period of 3 years is computed for 31-3-2019, and even for 15-16, the proceedings since had become barred by limitation will not be a valid notice. For 16-17, if it is issued after 1st July, it will be invalid if it is period of limitation is 3 years, but it will be valid if the income escaping assessment is more than 50 lakhs. And in all other cases for 18-19, 19-20 or 2021, even under the new law, since notice can be issued, then any notice issued after 1st July 2021 would be a valid notice and could be validly, proceedings could be validly initiated. I've covered up certain other decisions which surviving period has been also considered, and I will touch upon some other important decision of 2025. In Deepak Steels and Power Limited, this was a case of assessment year 1516, and following the decision of Rajiv Agarwal, it was held that the proceedings are barred by limitation of time, and the notices which were issued on 25th June 2021 were quashed. And the Rajiv Bansal case was being followed. In Delhi High Court, the case of Gopal Bansal, again, this was for 1516, and the notices which has been issued on 31st August 2024 were held to be barred by limitation of time, as the benefit of TOLA cannot be given to such cases. This was again a case of 1516 where notices were issued in August 2024. It was held to be barred by limitation of time. In case of Gujarat High Court, in Muhammad Azim, there multiple years were involved, assessment year 1314 to 1718. Yes. These were the important dates of Gujarat High Court, and assessment year 1314. The notice under section 140 issued under TOLA were all in June 2021, and they've computed the surviving period with respect to 30th June. For the notices issued on 17th June, the balance surviving period remains of 13 days. For 1415, which was issued on 9th June, 21 days, and for 1617 and 1718, the notices were issued on 30th June, and the surviving period was one day. The date of providing the information was in June 2022, 26th May, 23rd May, 23rd May for 1617, and 24th May for 1718. The SSC submitted the reply. Then, on the basis of the date of response being submitted, like in the first case of 1314, the due date was 9th June when the reply was to be submitted, and the period of 13 days when added. The last date for issue of notice was 22nd June. From the notice could have been issued till 30th June under the TOLA Act. The balance surviving period was computed, and that period of computation of the surviving day was added to the number of, after excluding the period of the TOLA period and the judgment when judgment was delivered, and the opportunity being allowed to the SSC for submitting the reply. That period, after excluding that reply and making the balance surviving period available, the notices, the last date was computed by the Honorable Supreme Court, which fell into the June itself, June 22 itself. And the notices in these all cases were issued on 25th July 2022. Therefore, it was held that the proceedings are barred by limitation of time. And all the notices issued were quashed because after considering the surviving period, the notices were held to be barred by time. I take another case of RMP Holdings, Delhi High Court, to further clarify what I'm trying to submit on the period of surviving period, which is to be computed. In this case, the original notice was issued on 25th June 2021. Therefore, the surviving days were only 5 days in this case. And the notice under 148A(b) was issued on 27th May 2022, and reply due date was 9th June 2022. and reply was filed on 7th June. And if the grace period, the surviving period of 5 days is added to the date when the reply was being filed, the due date of issuing the notice under 148 was 12th June 2022. And in this case, also when the notice was issued, it was on 27th July 2022. Therefore, it was held to be barred by limitation of time. Therefore, it is very important to see the surviving period time in each case, and on that basis, if the notice issued is within time, then only the proceedings will be held to be valid on the basis of interpretation of case of Rajiv Bansal and the case of Ashish Agarwal. In another case of before the Chennai bench, in case of Lakshmi Narasimha Sathi versus ACIT, the period of surviving period was computed. In this case also, the original notice was issued on 30th June 2021. Therefore, it was only on the last day of the Tola period when this notice was issued. The notice under 148 AB was issued on 2nd June 22 when after the judgment had come into place, and the reply was to be filed on 16th June 2022. Therefore, the limitation period was computed as 23rd June, and the notice which was issued on 28th July 2022 was held to be barred by limitation of time, and the assessment year involved was 1718. Another important aspect of which is recently is under a great controversy is the issue of notice. The first decision, the important decision rather, on this aspect of 151 was delivered by Bombay High Court in various cases. I will first take up that issue and then come back to other decisions. In Exaware Technologies, various important legal aspects were also decided, and presently the SLP against that decision of Honorable Bombay High Court is pending before the Honorable Supreme Court. And as I have come to know that almost more than 1,000 cases on this issue are presently pending before the Honorable Supreme Court. The first important issue, which was 1516, it was quashed on the ground that it's barred by limitation of time. The notice which has been issued on 27th August 2022, the proceedings are barred by limitation of time. Another important aspect which was decided in the case of Hexaware was the mentioning of DIN. In the notice issued under section 148, the DIN was not mentioned, and the notice dated 27th August 22, which was issued, it did not mention the DIN number. Though the letter which accompanied the notice under section 148, the DIN was mentioned, but it was held that if the DIN is not mentioned in the notice under section 148, the notice which has been issued under section 148 would not be a valid notice. The third important principle which was decided in the case of Exaware was the notice which has been issued by the jurisdictional AO and not as per the provisions of section 151A, which provided for the proceedings to be initiated under the faceless assessment scheme. The importance of faceless assessment scheme was also examined, and it was observed that the faceless assessment scheme was introduced with a view to have more transparency in the proceedings and eliminate the interference between the income tax authority and the SSC and any other person. And the objective was to optimize the utilization of the resources and introduce a team-based assessment and reassessment proceedings. Therefore, every notice which could be issued could be only under the faceless assessment scheme. And since the notices were issued by the jurisdictional assessing officer, the same were held to be not valid. The Bombay High Court in Prakash Patil and Dipanjay Roy had also taken a similar view. And recently, just a couple of days back, the SLP, which were dismissed earlier by the Honorable Supreme Court, those miscellaneous applications were being filed for review of those SLP being dismissed, and I've come to know that these SLP which has been dismissed in the case of Prakash Patil and Dipen Chadha has been recalled, and the proceedings would now be again decided on merits whether the jurisdictional AO and or the faceless assessment officer under the notice could be issued under the faceless assessment scheme only. And almost more than 1,000 cases on these issues are pending before the Honorable Supreme Court. And with the recent trend of decisions which have been coming, like the case of Ashish Agarwal or even in the case of Rajiv Bansal, while admitting that the proceedings had not been rightly initiated, the 148 proceedings were not valid, but still to safeguard the interest of the revenue, the law was let down, or rather, procedure was being followed to see that the taxation of right income or the income assessing tax should not, that there should be no escapement of tax on such income. A way out was, and harmony was tried to be laid down between the anomaly in the Finance Act or in the procedure which has been adopted. So it is, in my humble view, a very likely a view can be taken against the SSC in such cases also, that the notices which has been issued by the jurisdictional assessing officer may be held to be a valid notice issued, and the faceless assessment proceedings, if the notice had not been issued, because ultimately when the assessment proceedings have been transferred to faceless assessment unit and the assessment is being made in accordance with the said scheme, it may be argued that ultimately the purpose of the scheme has been achieved and only a notice has been issued by the jurisdictional AO to examine whether the proceedings of reassessment can be validly initiated in those cases. Another important aspect which has come into on this account is that in various search related cases, where the search is being conducted against one particular SSE and certain documents are found relating to other persons, the jurisdiction of those cases are being also transferred to the central circle or the investigation circle, and the proceedings under 148 are being issued directly without following the proceedings under the procedure laid down under provisions of section 148A. In those cases, since those are not research related matters, but maybe if say some agreement has been made or some transaction of purchase or sale has been made, that cannot automatically be treated as a search related matter, even though the proceedings have been transferred to a particular central circle. But straight away issuing notice under section 148 without following the procedure laid down under 148A, that matter again is under challenge before the various high courts. Another important aspect of related to search matters can be whether these kind of notices which have been issued, the transfer of jurisdiction which has been made, and without even giving opportunity to the SSC, and notices being issued considering those as a search related matters, and even without taking into consideration the other safeguards which are provided under section 149 or under 151, and the limitation which is being considered there is also under challenge in various cases, and I foresee that there would be a lot of litigation in those matters also. Coming back to another some important decisions, this was again before the Honorable Supreme Court in DCIT versus Rakesh Ramanlal Shah. This was during the election campaign. These proceedings were initiated on the basis of certain inquiry made. It's a Aryan Jewellers case. The seizure of jewelry was made by the state surveillance team and the district grievance committee, and the seizure of jewelry made by them was handed over to the income tax department. it was pleaded before the Honorable Court that as per the SOP of the Election Commission, there has to be satisfaction of the SST or the DGC, the District Grievance Committee, that the seized article, the seized cash, or the seized goods which has been transported and which has been found from the possession of the person belongs to some candidate and is for the purposes of election to and has been brought for influencing the voters. This is and there was absolutely no satisfaction recorded in this case, and straight away the goods which were found, having found that these are not related to any candidate, these were handed over to the income tax department, and the department on the basis of those proceedings initiated the proceedings under the person from whom the said goods were found. The Honorable Court also observed that the SOP provided it where the asset has been found, which is more than 10 lakhs, the report should be given to the income tax department. And having satisfied that no FIR, etc., was being filed, having satisfied with the content of the documents which were found along with the jewelry and the handing over which was made to the income tax department and the reassessment proceedings initiated on the basis of the Aryan dwellers who had been claiming over the ownership of those assets, it was held that the proceedings under Section 148 were not validly initiated and those were held to be not valid. I would like to take up some decisions with regard to notice issued to non-existing SEC. In the case of Sterlite Technologies, which is reported in 304 Taxman, the notice was issued to a non-existing SEC because the company in question had amalgamated with another company and the AO had issued notice to the erstwhile company which had already amalgamated was a non-existent entity, and therefore the notices issued under 148 to a non-existent SEC was held to be not valid. In another case of a partnership firm, Shri Ganesh Commodity Brokers, in this case, the reassessment proceedings were initiated in the name of the dissolved firm. And the provisions of Section 189 mandates that where a firm is dissolved, the EO can make the assessment of total income of the firm as if no dissolution has taken place. But the provisions of Section 283(2), they require that where the firm is dissolved and the said fact of dissolution has been informed to the AO, then AO is required to issue notice to the partners immediately before such dissolution. And therefore, in the present case where no notice has been issued to the partners, the proceedings initiated in the case of dissolved firm was held to be not proper and the proceedings were directed to be quashed. I think with this, I would like to conclude and I will thank the organizers to giving me this opportunity. I've tried to cover only the important decisions of latest 2025 and tried to cover the decision of Ashish Agarwal and Rajiv Bansal in a brief manner. And I would like and will be very happy if I can answer some of the queries which are being raised at a later point of time. Thank you. Thank you, Amit.
Hello, Amit sir.
Yes, sir.
Thank you, sir.
Thank you.
Sir, one of the query that has been received is whether appeal can be filed in case of TDS demand of interest and penalty for late filing of TDS returns.
Appeal against interest and late filing of TDS.
Whether appeal can be
Returns.
filed in case of TDS demand of interest and penalty for late filing of TDS returns. If the TDS return has been late filed and if any interest or penalty has been levied, whether an appeal can be filed for that.
It will be an order under Section 201A and the 246A. Order number 201 is appealable before the CIT appeals, and the shortfall of TDS can be challenged before the CIT appeals.
It is about late filing of returns. For that, if any interest and penalty been imposed, whether an appeal can be filed for that.
The orders under 234B had been challenged before CIT appeals and also before the Honorable Tribunal in various cases where the late filing of TDS return had been challenged. And uh, prior to 2015, I believe, where cases where levy was not specific, those levy were held to be not valid. And those were challenged before the tribunal and also before the CIT appeals. I will again check up and in the due course while the session is on, I will try to supplement
Right, sir.
my
Right, sir.
argument.
Right, sir. Okay, sir. And that's all I have received. Uh, I request anyone who wants to ask anything, any questions, kindly let me know. Okay. So now okay, sir. Now we have to proceed further, sir. So thank you, Amit, sir, for your exceptionally insightful and practical session. Your expertise has undoubtedly equipped us with valuable strategies for navigating reassessment challenges. Thank you so much, sir. So we are pleased to note that our participant count has grown to it has crossed 250 above, reflecting the widespread interest in this timely topic. So now for our second session, it's time to bring our second speaker. It is honor to invite C.A. Shubham Kapraji, a chartered accountant with more than a decade of hands-on experience in accounting, auditing, and financial reporting, specializing in the intricate technical domains such as business combinations, debt structuring, revenue recognition, leases, and share-based payments. C. Kabraji brings a wealth of knowledge to the table. His careers include substantial work with US SEC filers and Indian enterprises, offering robust cross-border reporting expertise. Currently serving as an associate director at Consulting, he draws on his Big Four background to deliver premium accounting advisory services. I invite C.S. Shubham Kabra to elaborate on the fundamentals and researching aspects of ASC 470. Over to you, sir.
Thank you. Thank you, Amit, and for the introduction. First of all, I'd like to, thank you the CPC committee for setting it up and, inviting me for the session. I'd also like to, set up the context that why did I pick, ASC 470, which is not very relevant from an Indian context, and it may be slightly more relevant for people who are actually trying to deal with, a cross-border transaction or, who day in day out deal with US specific clients or entities. With recent Trump's policies and a hiccup in overall geopolitical scenarios and Trump's agenda or Trump's goals on inviting the entities back to US and have the manufacturing or the service sectors setting up there. What really happens is it becomes a lot more important for the Indian entities who are based in US or the US entities who had business in India and who had taken these loans or debt instruments from US. Uh, they have gotten into difficult situations where either they can't deal with Indian markets, they can't deal with US markets, or the other Russia or Ukraine markets. And what really happens is the sales have started declining. They are not able to procure the materials that they can or they would have at a lower price, and the debt that they had taken has to go under the restructuring. Now, when we talk, let's understand, how the debt works in India versus how the debt works in US. I'll also be putting up my slides, but I'm someone who likes to talk on the context rather than going by the slides. So what really happens, when we talk in the Indian context, the debt is not very complex. The businesses give debt in a very, very specific or limited nomenclatures and formats. When you go to US, the debts are a little more complex. The interest rates are, slightly more driven, linked to market. Uh, when you get into modifications in India, you don't really have to assess whether the entities and under the financial strain or entities trying to modify something, and you simply go to a lender, you speak to them, you change, speak about the modifications of the conditions, and it happens, and then you assess on accounting. So India's 9 and 109 specifically deals with this particular transactions, and like we say in India, substance of a form is more critical than what is there in the documentation. So it is more on a practical aspect than specified in than being driven by a guidance. In US, ASC 470 and 310 or 370 specifically defines what the accounting has to be, and what the assessments or the procedures that the management has to perform in case of your debt restructuring. So with that, what has started happening is people who are dealing in, day in day out with US clients may end up getting certain requests where, they want to restructure their debt. They want to, they need an help around how to account for when, this restructuring happens. So this is what we'll be talking about today. I'll be putting up my slides, and let me just let me know when my slides are visible.
Yes, sir. It's visible.
Perfect. So now let's understand what the ASC 470 covers. So accounting standard codification 470 basically covers what is debt, uh, what is a troubled debt restructuring, then what is a debt modification, and what is a debt extinguishment. So, when we talk about that, it is pretty simple, in context of Indian accounting versus US accounting, that the instruments that comes into, the instrument that qualifies as a debt are pretty much same. It's either the notes, notes payable, or a banker's loan, a lender's loan, or, a derivative kind of loan. And these are specific formats that both the economies follow. Uh, when we talk about what happens when we account for an initial debt, again, the Ind-AS 109 versus AC 470 are not different. You simply, bring in cash and you create a liability in the books. The real changes happens when the first step, which is the modification or, the terms of the agreement changes. Now, what happens then? So, what ASC 470 suggests is you have to assess if the debtor is in a if the creditor is in a financial strain. Now, let's say your entity entity has started having a going concern issue, or the working capital has, diminished to a level where the entity is not able to repay its debt, or any other challenging situation that has arisen wherein the debtor is not able to pay the debt, and that particular debtor goes back to the lender and says, I want to modify this debt and I want to re-agree on the terms of the contract. Once this happens, this is actually called as a trouble debt restructuring. So to summarize this, any debt restructuring that happens because the debtor is in a financial strain is a trouble debt restructuring. Now, when you try to when you get into an or modify that particular agreement, it has to be assessed as a debt modification or extinguishment. We will discuss in detail. I've also set up an example to run you all through what a modification looks like, what an extinguishment looks like, and what are the typical accounting entries that we generally do for this. Now, yeah. So like I said, the qualifying criteria for SC 470's TDR is if there are any hardships that exist, and because of those hardships the terms are modified, uh, accounting implications, the agreement gets changed, the company has to disclose what really changed around this TDR and how the agreement shuffled. When you account for in TDR, the data does have to change a lot of things in their books. For creditors, it for creditor, it does not really change a lot. For creditor, he simply assesses what was my cash outflows before the modification, what is my cash outflow after the modification, and the accounting entries gets passed for differentials. For debtor, a lot of things has to change. Now, for debtor, he may not recover certain amount from the data when he is trying to, or when he has gotten into a TDR agreement. So what he has to do is he has to assess a credit risk. What has he lost? That credit risk has to come into books. Once that gets accounted for, your the new loans, or the receipt of new loans, the modification schedule gets revised. So that's how the TDR is being accounted for. Now, what are the general examples that you may see when you're assessing a TDR? Like I said, the fundamental of it is that your debtor is not able to repay the loan. Now, when he's not able to repay the loan, he may request for an interest rate reduction. He may request for an extension of the loan. He may request for a debt forgiveness, or he may request that my partial debt should be forgived, and I can pay only this much of amount, and this gets restructured. What are my financial impacts around it? My financial impacts are my interest income gets changed for data, my loan balances gets changed, my cash flow projections for debtors and creditors both changes. So for the interest income and loan balances, both the books of accounts has to change for debtor and creditor. For creditor, it simply applies the CECL, which is credit risk assessment, and he has to make a provision, account for that provision in the books. For debtor, he simply has to assess whether what was my cash outflow before I took the loan, what is my cash outflow after I took the loan, or after I modified the loan. Once that happens, he goes back and accounts for the differential adjustments. The next step, once let's say you assessed whether it was in TDR. Now the TDR is one set of accounting that happens. Now let's say the debt was not in TDR; it was a simple modification of the loan. Now, what is a simple modification of the loan? How do I define a simple modification of the loan? So the ASC 470 has defined a substantial modification criteria for these loans. First of all, what has to change, when I evaluate whether is there really a debt modification, or, is that not really a debt modification? So there are, things in agreements which may impact my ultimate cash flow. What are those things? One is my interest rate payment. Second is my payment schedule. Third is my maturity date. These are the three major things which, if changes, my cash outflows will have an impact. With that particular cash outflow, I have to assess whether it is a substantial modification or it is a non-substantial modification. In case of a substantial modification, it will be treated as a debt extinguishment. What is an extinguishment? Extinguishment is simply my what US GAAP suggests is, if your cash flows, the present values of the cash flow exceeds more than 10% on the date of modification, then it is a debt extinguishment, which means you have ideally finished off your earlier loan and you have taken a new loan. So it has to be treated as a new debt recognition. If your present value difference of the cash flows is lower than 10%, then you do not have to treat it as a debt extinguishment, which means your existing loan stays as it is, and you just have to account for your for the modification impact, or to take the modification impact. Now, what really changes, when the extinguishment happens versus when the modification happens? What are the entries that we generally do? So, in case of extinguishment, your old debt entirely go out of the book. You treat it as a repayment, and then you account for it as a new debt. If it is a modification, then the only adjustment that are being made to the carrying value of that particular loan, which is an existing loan. Now, let's say my interest rate changed, or my payment schedules changed, and my cash outflow increased because of let's say I increased the duration of the loan, and my cash outflows went up. Now, I only have to record an additional liability and say that, this was my additional, or, this is the modification of my debt. let's say I took an additional loan of $5 million. I already, let's say, had an existing loan of $100 million. I topped it up with $5 million. Now, the cash flows haven't changed by more than 10% when I assess the present value. Then I just have to account for the modifications. I have to account for additional $5 million as part of the same agreement. And I just have to top up my debt liability on the date of modifications. If, let's say, I had an existing loan of $100 million, I took an additional loan of $200 million, and I said I'll first prepay the $100 million loan, and then I'll keep the rest of the amounts in my books. In that case, your cash flows have changed by more than 10%. So once it changes by more than 10%, you go back and you say, I have prepaid my old loan, so that liability has to go off my books. I have to account for the additional loan that I've taken. So, it becomes an entirely new loan, which is $200 million. And that's how the accounting happens in case of substantial modification or non-substantial modification. Yeah, we talked about the debt extinguishment. Yeah, so before we go to example, I would like to just reform what are the assessments that we would make. First, let's say you get an agreement from the client, you compare both the agreements, you go back to client and you say, I want to see your financials. When you see their financials, you have to see whether the debt is in whether the data is in a financial strength. If not, then you move to next steps to assess whether it is a debt modification or it is in debt extinguishment. If it is a modification, we account for modification. If it is an extinguishment, we remove the old loan from the books and recognize the new loan. And basis the old versus new, whatever the gain and losses happen in the books, that gets accounted for in the P&L. These typically are the disclosure requirements in ASC 470 when you're preparing the financials. You have to disclose what are the nature, terms, rational, and accounting treatment that I've done for a substantial change, which part or terms of the loan did get changed, what are the accounting treatments that we follow, what was the gain and loss that we reported in the balance sheet or P&L, where did we recognize it, what will be my financial difficulties if I've gone through the TDR assessment, is there a concession that I've gotten from the lender, is there an impact on my future cash flows that I've made. So these are the disclosures that we generally make in the books. I will just reshare my screen to set up an example, and then we'll talk about that particular example to see if there are just let me know if you can see my screen again. It's an
Yeah,
Excel sheet.
it's visible.
Okay, perfect. So I have set up a mock example on how do we assess a modification versus the extinguishment. So let's say I had a loan from one particular lender, which the initial loan, which is the existing facility that I'd taken, was for $50 million. And these $50 million I was supposed to get into three tranches based on the milestone that I would achieve. So let's say first milestone was $25 million. That was on the setting up of the loan. Second milestone was $10 million. Let's say I had to achieve certain revenue and then I would get it. Third milestone was $15 million. I would again achieve certain milestone, the revenue milestones, and then I'll get it. The maturity date of this loan was 1st September of 2027. The end of term charges was $2.4 million. I had to incur $600K for facility charges of this loan. And then I had to pay interest rate of 9.9%. And if I had to prepay ever this loan, I had to additionally incur 350K USD. I went into a restructuring agreement with my lender, and I said I want more commitment from you, and I want to re-enter into an agreement and restructure my debt. So in the restructuring agreement, I increased the total commitment from $50 to $100 million. My tranches changed based on that. So my first tranche became of $35 million, second of $10 million, third of 20, and fourth of 35, depending on the respective milestones. So it is only the first tranche that I get as part of my initial loan setup. My maturity date is 48 months from the closing of the loan. My end of term charges, what happens is I still have to pay the initial loans end of term charges pay and end of term charges. I have to incur 1.3 million of facility charges. My interest rate did not change, but my prepayment charges exceeded to $1 million, depending on the additional commitment. Now, how do we assess whether it is a debt modification, whether it is a TDR, it is a debt extinguishment? So, in the first step, we have to see what was the reason that the debtor agreed or changed the term loan or went into a different loan agreement. So, we have to pick up the financial of the debtor. We have to say or see whether the financials or the cash flows are negative for the financials. If the cash flows are negative, then does the company have a negative working capital and does not have a capacity to repay this loan? If yes, then we will simply say it is an TDR. Let's say both of these things did not happen. What we see is, did my total commitment declined because of the loan? If yes, and if the creditor has waived off something, if yes, then it is an TDR. If let's say my interest rate also increased from the initial loan, let's say initially I had to pay 9.9%, and if now on a revised loan I have to pay 13%, and my liability because of that loan has increased, and let's say my EMIs because of the agreement has decreased, then also it is a TDR. Now a combination of these factors will become a TDR. Let's say when we conclude it is a TDR, my accounting will be different, like we discussed. So I'm assuming that, in this particular case, it was not a TDR. So we had to move ahead and assess for debt modification and extinguishment. When I have to assess for a modification and extinguishment, I have to see what are the terms that changed and whether it was a substantial change. Now, the substantial change is in US GAAP defined as a 10% cash flow test. And this is the exact wording that standard uses, that you have to perform a 10% test or 10% cash flow test. Let's see what really changed in this particular loan. First of all, my total commitment changed. So I'm marking an X on, what really changed. So my total commitment changed, which was for 50 million and $100 million. I'm assuming that when I entered into a restructuring agreement, I had only drawn the tranche 1 and I did not qualify for tranche 2 and 3. So I had only drawn a loan to the extent of $25 million. In the new loan, I'm only getting, I'm assuming I qualified for tranche 1 and tranche 2, which was 25 and 10 million, 35 million. And in the new loan, I'm only getting the $35 million for now, which $35 million I'll be using to repay this 25 plus 10. And then, when I meet the next milestone or hit the next milestone, I'll get the $10 million. So my tranche changed. Did my maturity date change? Yes, my maturity date also changed because of the additional commitment. Did my end of term charges changed? Yes, my end of term charges changed because I still have to repay the existing facilities loan even when I'm opting for the new facility. Did my facility charges change? Yes, my facility charges also changed. Did my interest rate change? No, my interest rate did not change. Did my prepayment charges change? Yes, my prepayment charges changed. Now, since we have assessed what really changed when I was I have re-entered into an agreement, we do have to go back and see whether this qualifies for a 10% variances between the cash flows. So this is where we have assessed a 10% cash flow test for this. So what did happen in my old loan? Okay, now in the first place, what will be the existing information that I have, from the client or when I'm assessing this loan? The only things that I'm going to have is an agreement plus my old loans amortization schedule. Based on these two, and so what I have to put together after that? So I have to put together a new term loans amortization schedule to compute an effective interest rate. When I'm assessing if it was in TDR, I also have to see whether my EIR did change or increase from the previous loan. If it did not, then it does not really matter. I have to still go back and see whether it was a modification or it was an extinguishment. So let's say I go back and see, the cash flow test. I say my old loan was $35 million. My accrued interest uh, when I had entered into a restructuring agreement was 28K. My end of term charges was 2.4 million that we discussed. My facility charges were 350 million. So this was the total cash outflow that I had to pay at the time of modification of loan. This is my new loan. Again, like I said, I am only withdrawing the first tranche, which is $35 million. This is my end of term charges for old loan. These are my end of term charges for new loan, and these are the respective facility charges and all the other things uh, when I have to repay the loan. Now, the one question that may arise is, when do I check the 10% cash flows? There is no particular guidance around when do you really have to assess this 10%. What the guidance says is, the first assessment happens if, let's say, you assume that you will repay the entire loan on the day when you take the new loan. If on that particular day your cash flow changes by more than 10%, then it is an extinguishment. You are simply re-raising a new loan and you are paying off the old loan. If, let's say, it did not so happen that your variances, your cash flow changes came more than 10% on day one, or the cash flows increased by more than 10%. Do I just assume that it is an extinguishment? No. You can take a different assumption. You can say, let's say I had to repay this loan after a year. Does my cash flows vary by more than 10%? Let's say I had to repay on the sixth month of sixth end of month of six. If even on that date, let's say it did not change, or the variances were more than 10% or less than 10%, you will say it is modification. It is not extinguishment. You can say I'll assume it is a 2 year. So you can take up any multiple scenarios and see whether, on even if it qualifies on one particular day that it is less than 10%, you can assume it's a modification. So in the entire duration of loan with different conditions, you can check this cash flow test. And if it ever goes below 10%, then it is a modification, it is a not extinguishment. So conclusively, it has to go more than 10% across scenarios that you assume. Are these scenarios defined in US GAAP? No, these scenarios are not defined in US GAAP. The US GAAP only says when you're testing for the cash flow test, or when you're testing 10% cash flows, you have to take all the cost that you have to pay on that particular day. Be it your prepayment charges, be it the end of term charges, be it any changes in the fair value of any asset or liabilities that have been generated out of that loan, be it an accrued interest, be it the principal outstanding of that particular loan. So any the cash outflow that may happen on that particular date is what you should consider when you're assessing the cash flows. Now, we did check on, assuming that my prepayment happens on the day one of amendment. So this is my first test. I check that my existing loans repayment in entirety, if I pay on day one, would be 37 million. My new loans, if I had to repay my new loan on day one, my outflows would be $40 million. So let's say this, what we do is we compare this 37 versus 40, and we say my modification is only 6%, or my cash flows is only varied by 6%. So it is not a debt extinguishment, it is simply debt modification. When we assess that it is a debt modification, what is the next step? The next step is we go back and we say, how do I account for, about this modification? So in the first place, we have to, see what is my amortization schedule going to look like on day one. So I have to see what is there in my books as of that date. And since it is a modification, I just have to account for an additional liability or asset in the books. My principal amount since day one, it was $35 million. So my principal did not change. It was 35 versus 35. My installments did change because my period of the loan did change. My contractual interest rate did not change. Was 9.9 before, it is 9.9 now. Now, there are few costs that, we capitalize as part of the loan when we are accounting for under US GAAP. One of that cost is my debt issuance cost, and second is my debt discount cost. What is a debt issuance cost? So debt issuance cost is any cost that you have incurred on a particular date when you were taking up that loan. In this particular case, what are my debt issuance costs? My debt issuance costs are my end of term charges, my facility charges, but not my prepayment charges. Prepayment charges will only incur if I'm prepaying this loan. So it has to be accounted for as and when I incur this, unless I am actually going to pay it early. So these two are my debt discount or my debt issuance costs. Now, what additionally could be in debt issuance cost? Let's say if I had issued some warrants or some equity shares to the company or to the lender, and I had to fair value that warrants or the equity shares. When I had to fair value that equity share or warrants, and the cost of those warrants or those shares also become my debt issuance cost, which needs to be amortized over the period of the loan. Uh, so generally, what happens is, let's say if I had, if I pay if I got $35 million, how it generally happens is, or if I take any simple examples, let's say if I'm taking a vehicle loan in India, uh, let's say I applied for a loan of 10 lakhs, or let's say 10 lakh 10,000. All the charges that happens on day one, which is my service charges, my debt issuance charges, gets deducted from day one's EMI, or I get that much of lesser portion when I get that loan. Specifically in personal loans, that happens when you take in India. I think vehicle loan is not a right example, but personal loans may be a right example. If you're taking a personal loan in India, it says, let's say if you're taking a 10 lakh for personal loan, and the issuing charges, let's say 25,000. The bank will only credit 9,75,000 to your account. So 25,000 goes as in debt discount on day one, or debt issuance cost. Now, what happens to 25,000 when you're accounting for under US GAAP? You capitalize those 25,000 and you amortize over the period of the loan. You treat it as same as what your total amount borrowed looks like. So in this particular case, we got $35 million at an installment for 1.4 million, an interest rate of 9.9%. My debt discount from the existing loan. Now, when I say existing loan, do I still have to pay this debt discount? I have already paid this debt discount, but now my amortization period of this debt discount changes. Let's understand what happened in the old loan. What was the outstanding amounts? So my initial fundings, like we discussed, were $35 million. These are the fees and the other items that we incurred over the period of these 2-3 years, and then we arrived at a carrying value. This particular carrying value, we identified, and for this particular carrying value, we identified an effective interest rate for amortization, and we started amortizing it. This modification happened, let's say, somewhere in the third year of the loan. So for these 3 years, I had already started amortizing my warrant fee, my cash fee, my issuance cost, or whatever discounting and costing that I incurred for this particular loan. When I'm modifying, or when I'm taking a modification accounting into place, I only take the unamortized portion of the the old loan or the old cost and account for it. Let's say what would happen if my principal gets changed. Let's say if this 35 had become, let's say, 37. Then what would I do is I will also add an amount borrowed of 200K, and I would say this is, or $2 million, and I would say this has become 35 to 37. My installments would go up and down. My contractual interest rate would stay the same. My unamortized portion of discount again will stay the same. I'll take it from the old loans books. My issuance costs unamortized portion, I'll take it from the old loan. Like I said, my shares and warrant issuance, if anything, I have to get it to fair, have to get it fair valued, and I have to see whether that fair value has impacted in a gain or loss for me. If, let's say, my fair value got increased, my shares, let's say if I had issued 10 lakhs of shares to the lender, and the 10 lakhs of shares became 15 lakhs of shares, then I have to incur an additional cost when I'm repaying the debt, or when I'm buying back my shares. So I again have to incur and say, I have to account for the additional 5 lakh rupees, or $5 lakh of cost when I'm accounting for this debt. Once you have carried forward from the old loan, you have to see what are the additional costs that you're incurring on the new loan. Now, in the new loan, I am incurring an additional cost of 412K, which is the facility charges for the new loan. So that you have to account for. Then you have to see what are the term loans, earlier loans charges, what are the new loans charges. And when you arrive at a total cost, you have to arrive at an EIR for the amortization of the new loan. Once you've arrived at the EIR of the new loan, you would say that this is how I'm going to amortize for the rest of this period. When you have done all of this, when you have accounted for this entire have prepared the EIR schedules for the old loan versus the new loan, you say, now I'm going to go back and see what really changed in my books. Now, let's say, in terms of gain and losses, what did happen? The gain and losses happened because my debt discount changed from an old to new. My issuance cost changed from an old to new, and my end of term charges changed. And then on day one, you have to assess what is the journal entry that you're going to pass, or you have to record. So in this particular case, what happened was on day one, I had to pay an accrued interest to the lender. I had to incur an additional equity of 163K, which was the net of the total expenses that we saw above. I had a financing fee, which was the end of term charges, debt issuance cost for the new charges was 412K. And the total of these has to get into my P&L. So these are the gains and losses that I see out of this particular loan. And like I said, in the modification accounting, we only account for what really changed from an old to a new loan. Had this been a case of a debt extinguishment, what would really happen is we would go back and say, I would have paid this, let's say now, let's assume this 35 million would have become a 70 million. I would have, let's say, taken out two tranches on day one. Now this 35 became 70. What would happen? If had this 35 would become 70, I would say I am repaying this 35. I am generating an additional capital of, $35 million. And I am getting an additional funds to support my existing business. We'll have to go back to cash flows. I will say my cash flow changed by more than 10%. My cash outflow since since I've taken extreme values. If I will ever compare from 35 to 70, it will always be more than 10%, even if the period is larger than the existing loan. So on day one, I have to repay $70 million, and my principal would have changed. Now I would say this is a debt extinguishment. So debt extinguishment is more simpler than modification accounting. If had this been a case of extinguishment, I would say I will repay this 37 million. So I'll take off my liability from books, for this $37 million. I'll say my cash has gone out, my liabilities wiped off from the books, and then I'll recognize the $70 million in the books, which will be the new loan amortization. So this is how this modification versus extinguishment assessment happens. Now, what really is the difference between Indian context versus I'm just resharing my screen to be at the slide. Sorry. Yeah. So what are really the difference between, when we assess around the Indian context and, when we talk about the US concept? So the accounting framework, generally in India, what we follow is a substance over form accounting. Let's say my loans had changed because I had to see a certain modification in different terms and conditions of the agreement. The US government or the US GAAPs have a clear set of things defined where they say it is a rule-based specific guidance accounting. I have to just follow simple steps. First, I have to see if it is TDR. If it is not a TDR, I have to go back and see it is a modification. Then I have to arrive at whether it is an extinguishment, or whether it is an modification. In India, what we generally see is we compare the different terms of the loans. We say whether it was a substance over form or not. If let's say my loan, even if my loans did not change more than 10% in India, I can end up saying that it is an extinguishment because a lot of values or the modification did change from my existing terms. Then the next is TDR. The Indian accounting standard does not have a concept of TDR. my all the modifications that happens, generally we follow Ind AS 109, and it gets accounted for under the same method. Even if it is an extinguishment, it is treated. Let's say if it was an extinguishment because it was a TDR, I don't really have to go back and see the CECL accounting in the creditors book. So creditors books are dealt, with a different standard, and my debtors books are treated with Ind AS of 109. But in US, I have to go back and see whether it was in TDR. And if it was in TDR, my set of disclosures changed entirely. We have to, like I said, we have to assess whether it was an, TDR because of financial strain, and those particular disclosures needs to be made. So, uh, yeah. So these are, the typical assessments that we make in, when we are assessing debt modification versus debt accounting. So Amit, this is what I wanted to cover. If we have any questions, we can take up.
Yes, Shubham.
Yeah. So I mean, I think I have pretty much covered around the guidance and summary. So we can take up the questions if there are any.
Yeah, I am looking over that, that
Mhm.
portal. If any questions is pending, I'm just checking it out.
Sure.
No, I have not received any questions. If anyone want to ask any question, just let me know. I am waiting. Okay, sir. I'm not receiving any questions. I
No
think we
worries.
should proceed further, no?
Yeah. Yeah.
Right. So moving further, our heartful thanks to C.A. Shubhamji for delivering such knowledgeable and forward-looking content. Your sharing on debt accounting will provide instrumental in our daily practices. So, respected participants, as we conclude this highly insightful 61st webinar organized by CP Committee of the ICI, it is my distinct honor to propose the vote of thanks on behalf of the organizing committee and all attendees. First and foremost, we express our heartfelt gratitude to our learned speakers, C.A. Amit Kothariji and C.A. Shivam Kabraji, who have so generously shared their deep expertise with us this afternoon. The clarity and depth with which you illuminated both the complexities of reassessment proceedings under income tax and ASC 470 debt accounting have enriched our understanding and professional perspectives. We are especially grateful to C.A. Satish Kumar Gupta ji, Chairman of the CP Committee, C.A. Vishnu Kumar Agarwal ji, Vice Chairman of the CP Committee, for their inspiring guidance, visionary leadership, and constant encouragement that make knowledge sharing events like this possible. Thank you to the CP Committee and the entire ICI team for their immaculate planning, seamless coordination, and unwavering commitment to professional development. I also wish to thank every participant who joined us today. Your engagement, attentive presence, and enthusiastic questions transform this webinar into a vibrant exchange of ideas and experiences. Last but not the least, heartful appreciations goes to everyone working behind the scenes who diligence and support ensure that smooth and successful content of today's session, especially to Akshat, Nisar, and Shrey. With this, we bring to session to the close. Thank you everyone for making today's event truly meaningful. Wish you all continuous learning and professional growth. Thank you.
Thank you, Amit.
Thank you.